thing. Okay, so everyone's giving F7 in the coming week. Hello, can you all hear me?
Yes,
Okay,
it's
you
Yes, sir,
all.
we can hear you.
okay, you all can unmute your mic so you can talk. It's fine. Okay, so everyone's giving F7 in the coming week, or you all are just attending it for a revision class.
We are attending it for revision class.
Okay, so anyone who's all giving F7 next week and is there in the class right now? No one? No one's giving F7 next week? Pavan, Prachi, Rahul, Vishwam, anyone who's giving F7 next week? Okay, never mind. So, can we keep this class interactive and can you all talk? Okay, only me talking will make the class very boring.
Yes, sir.
Yes, sir.
Okay, Prachi, can you unmute? Rahul, can you unmute? Can you just type in the chat box if you all are there in the meeting at least? Prachi, Rahul, Vishwam. Okay, so let's begin. So it is a 2-day session. Okay, I'll be covering half the topics and Nitish sir will covering half the topics tomorrow. So you all can attend tomorrow's class also 4 to 6 same timing. Okay, so I will do most of the accounting standards, PPE. So anyone knows what is the account? I will start with the first one, which is your tangible non-current assets. Anyone knows which is the accounting standard for PPE? You all can type it in the chat box. Which IAS it is? Right. So IAS 16. IAS 16 PP. Okay. Just a second. Okay. Before starting with IAS 16, can anyone tell me what does a statement of a full financial statements include? What all are included in a financial statement? You all can type it in the chat box. You all can speak up anything. What all is included in a financial statement? Anyone? Speak up or type. Okay, statement of financial position, statement of P&L, statement of change in equity, cash flow, and notes to accounts. Okay, so I'm not sure who is this. Uh, the name which is given, the number, who is it? Can you tell me your name? 9599308190. Preeti. Okay. Okay, Preeti. So that is exactly what financial statements include. Everything you mentioned. Okay, so that was the first chapter as such. Okay, let's come to your IS 16 PP. Now, does anyone know what are the different types of uh, methods for recognizing PP? If anyone knows, just type it in the chat box. Different types of methods to recognize PP or to value PP in your financial statements. Has anyone studied F7? You all should know this. There are two models, okay? So one is your cost model and one is your evaluation model. Okay, so yeah, measure at cost model or measure at evaluation model. Okay, let's see what the cost model is. Okay, we'll see what initial measurement of your PP is. Okay, I'm not going to read everything. I'll just Chandrika, are you there? You can type in the chat box if you can see my screen, or you can just speak up. Chandrika? Chandrika, just type in the chat box if you can see my screen, you can hear me. Just put a thumbs up or a hi or something. Okay. So Chandrika, we've started with IS 16, which is your property plant equipment. We are on the initial measurement when it is measured at cost. What all do we include when we need to initially recognize a asset? Okay, so we include all costs which are involved in bringing the asset to working condition. Can anyone tell me an example of this cost? Anyone can type in the chat box an example of any cost which is uh, involved in bringing the asset into working condition. Setting up the machinery will be involved in this such a cost. Okay, only machinery, you if you bring different parts of the machinery to the factory and then you set it up, setting up of those machinery and that will involve some cost. Okay, that cost will be capitalized, so it will include all initial cost capital such as cost of site preparation, delivery cost, installation cost, borrowing cost. Can anyone tell me if training costs are capitalized or not? So you've got a new machinery, you need to train people to use it. Do we capitalize that cost or do we expense it? Okay, such costs are always expensed. Vishwam, we don't capitalize it, we will expense it. Okay, similarly, there is dismantling cost. So dismantling usually happens, say, after the useful life of the asset. Okay, so uh, you need to account for it. It is a future cost, but account for it at present. So what we do is we get the future cost to present value. So if you see this formula, 1 divided by 1 plus r raised to n. So your rate will be given. I'm sure you all know how to convert a future cost into present form? Anyone who doesn't know? Anyone who doesn't know this formula? It's just 1 divided by 1 plus the interest rate raised to the number of periods. Okay, very simple. You get that, you multiply it into the dismantling cost which will be given in the question, and you can then capitalize that amount. Anyone can tell me what amount goes to the PNL with respect to dismantling cost? So every year we need to uh, unwound the discount. Okay, so Chal, in the last year, uh, the dismantling cost will become zero. So can anyone tell me what cost or what is the unwound cost we present in the financial state or in the PNL?
Sorry to interrupt you. I have one query. If the
Yeah.
if the machinery is new one, and the machinery whatever we bought, we need to get the training in the initial period. At that time, we have to include the cost of machinery, right? Is that my assumption correct?
Can you repeat your question
The
once?
machinery is new one,
Machinery is new.
yeah, which includes some sort of technical kind of thing wherein training, the cost of the machinery includes training cost. Suppose if the machinery is new, at that time we should capitalize the initial days of training cost also. Is that my assumption correct?
No, training cost will never be capitalized. So I'll give you a simple example. Do you think training of an employee for using the machinery is required to get the machinery into working condition? Working condition, okay? Doesn't matter if you're using it or no. It's in working condition. Do you think training is a necessary cost for that?
No.
Okay, that is why it will not be capitalized. Be it
So,
if it is a new machine, any machine. Okay, training costs are never capitalized.
so here the key point is working condition, right?
Right. It should come into working condition. Okay.
Okay.
Doesn't matter if you're using it or no. Okay. If it's in working condition or any cost which is incurred to get into working condition, then you will capitalize it.
Okay. Got it. Thank you.
Okay. Now, can anyone tell me what costs are expense to PNL with respect to dismantling cost? Anyone? Okay. So once we calculate the
Labor.
dismantling cost, what?
Labor for dismantling.
Never, what, never?
Labor. If there is related skill set, people only required. At the time, it will part of dismantling cost, right? Labor.
Right.
Labor.
Right. So, uh, Preeti is right. Finance cost, unwinding of discount to PNL. This is what I was looking for. So once we calculate the dismantling cost, you multiply it with the interest rate given. Okay, that will be a finance cost for you in the PNL statement. So say 1,000 was your present value of the finance cost, and the useful life of the machinery is 4 years. So every year you will charge 2,50,000 to the PNL. Okay, that's how after 4 years that 2,50,000 will become 1,000. Okay, so 250 will become 1,000. That is what I was looking for. Okay, anyone has any doubts on the initial recognition or initial measurement of property, plant, equipment? Unwinding cost include related labor. No, they don't include related labor. Unwinding cost is only your dismantling specific dismantling cost, which will be given in the question. Anyone has any doubt with initial measurement?
Sir, in the third point, can you give some examples?
Revenue cost, this one.
Yes, sir.
Okay, this is your labor cost, revenue cost or training cost, you can say. Revenue cost should be written off as incurred. So without training your employees, you will not be able to earn revenue from that machinery. Okay, that is a revenue cost for you. So that is why it should be written off as incurred. Okay, so
Okay, okay, got it.
training cost is an example of your revenue cost. Okay, anyone any doubts in any points till now? Okay. So let's move further. Okay, let's see one of these illustrations. So if an oil rig was built in the sea, the cost to capitalize is likely to include the cost of constructing the asset and the present value of the cost of dismantling it. Okay, if the asset costs 10 million to construct and would cost 4 million to remove in 20 years. Okay, so in 20 years, after 20 years, you have to incur a cost of 4 million to dismantle the whole oil rig. Okay, present value of the dismantling cost must be calculated. Interest rate is 5%. The present value of dismantling cost is calculated as below. So you calculate 4 million into 1 divided by 1 plus R. Okay, R is your 5%. So it's the same formula out here. 1 divided by 1 plus R raised to N, which is your 20 years, which is given here. Okay, you get this. The total cost to be capitalized would be your 10 million, which is your asset, plus your dismantling cost of 1507, which we calculated. Now you depreciate this over 20 years, okay, straight line method. And this is what I was asking you all. What should be expensed to the P&L? Okay, so each year the liability would be increased by the rate of 5%. So 75,378. If you calculate 5% of 1707,558, you will get this much. Okay, this is expense to P&L. Anyone who has any doubt in this question? Anyone, any doubt? You all can type it out. Okay. So this type of question is very important when it comes to your 2 marks MCQs. So I'm sure everyone knows what the paper format is. Okay. As far as I remember, it is 60 marks of MCQs. Okay. 20 marks, I think 15 into 2 and 3 into 10. Okay, so 60 marks MCQs is very important, and other 20 for 20 marks, 2 questions. So out of that, one will be consolidation, 90% will be okay, and the other question can be from any part of the syllabus. Okay, now let's come to subsequent expenditure. Can anyone tell me what are the subsequent expenditures which we can capitalize? Anyone in the chat box, you all can write it down.
Rehauling.
Right. Okay, so one basic example of this is airplanes have to change their seats every, say, 5 years. Okay, so that is a type of expenditure which they can capitalize. Okay, so your major repairs and maintenance of maintenance to improve efficiency of the asset. Okay, right. So these subsequent expenditures are capitalized. Okay. Now, does anyone know what are the different types of depreciation methods? Okay, I think everyone knows this. It is your straight line method, reducing balance method, and your machine hours. Machine hours is not asked usually. So it is straight line and your reducing balance method, which is your written down value method. Okay, it's the same thing. Okay. Now, how do we go about a question where useful life of the asset changes? So I'll give you an example. Someone, say Preeti, you bought a machinery and you figured out that the useful life is, say, 6 years. After 2 years, you find out that I can use this machine only for 1 year. Then in that scenario, what do we do? Does anyone have any idea how to go about such scenarios? You all can talk, you all can tell me if you all know about it.
We will recalculate the depreciation in the subsequent periods.
So, right, you will recalculate it for sure, but how much can you reverse? So previously you must have calculated depreciation for 6 years. Okay, after 2 years you come to know I can use it only for one more year. So your useful life changes to 3 years, right?
Right.
Okay, so previously when you were calculating depreciation for 6 years, your charge would be less to the PNL, and now suddenly it would have increased. So how do we do that? Okay, we'll see a question on that. Okay. So an asset was purchased for 100,000 on January 1. Again, this question very important for your MCQ part. Okay. On 1st January 2025, straight line depreciation of 20,000 per annum is being charged, which is 5-year life, no residual value. Annual review of asset life is undertaken for this particular asset, and the remaining useful life of 1st Jan 2027 is 8 years. Okay, so in this scenario, our useful life has increased rather than decreased. So, what is the depreciation charge for the year ended 31st December 20x7? Okay, I'll just explain how they've gone about it. Okay, first of all, can anyone tell me how many years of the machineries have passed by when the change was known to us?
2 years,
How many?
2,
2, right? So 1st Jan 20x5 to 1st Jan 20x7. So that's what they've done, 2 into 20,000. So that is our depreciation for 2 years, and 1 lakh was the amount. So now we have the carrying amount as at 31st December 20x6. Okay. Now on 1st Jan 20x7, we come to know that the asset has a useful life of 8 years. Okay. So whatever is the amount, 60,000 is left into 8 years, we can calculate 7,500 per year as a depreciation charge. This was simple, but I'm not sure if this textbook has it, that when the asset life is reduced rather than increased. Okay, so it's there in your strategic business reporting, which is your advanced version of FR. So probably in that time you all will learn about it. Okay, I won't go into detail right now because then you all will get confused. So everyone's clear with this part? Okay. Now, revaluation of non-current assets. Okay, so firstly, this was the first question I asked you all. Where are the two models which we can use? So one is your cost model and one is your reval model. Okay, initial recognition of either of the models is the same. So whatever we've done on top is initial recognition, it will apply to any of the models. What happens in cost model is very simple. You take property, plant, equipment, whatever you initially recognize it at cost less accumulated depreciation. Every year you calculate depreciation and you subtract it from the price every year, okay, till your useful life ends. Can anyone tell me what happens in reval model?
There may be a gain or loss, something kind of changes.
Right. So where does the revaluation gain go? Anyone? Any idea?
Equity.
Equity. Okay, so it's some there's something known as other components, other comprehensive income. Okay, now, from that other comprehensive income, the revaluation gain is reclassified to equity, which is your other changes, your statement of changes in equity. Okay, that happens every year at the year end. You transfer all reval gain from OCI, which is your other comprehensive income, to equity. Okay, anyone, any idea about revaluation? Similarly, that goes for your loss also. Okay, reval loss. Okay, first of all, does reval loss go to OCI or PNL? Will you hit your PNL directly or your OCI? Right,
PN.
okay. Onward revaluation goes directly to PNL. Now, if previously for the same asset you revalued it upwards, Okay, and now the revaluation has gone down. Then what do we do?
Sorry, come again the question.
Okay, we had one building. Okay, it was in the financial statements at say 100,000. Now the fair value is 110,000. Okay, so 10,000 will go to your OCI, right?
Yeah.
Now in the next year, that same building which was at 1,10,000 has dropped down to 90,000. Then what do we do?
So it will affect only in OCI itself.
Pardon?
It has to be adjusted in the OCI itself because earlier the same place we have increased the value. Now it is value got down. The same adjustment should be made there itself.
Okay, so my value has dropped down by 20,000. In the OCI, I had a balance of 10,000. Then,
Then it will come 8,000.
so 10,000 of the OCI will get reduced. The other 10,000 will get charged to PNL. Okay, so my value, which was at 1,10,000, has dropped to 90,000. Previously, I had a reval gain in the OCI for 10,000. So that 10,000 I will reverse, and the other 10,000 which has dropped will go to directly to PNL. Anyone, any doubts in the reval model?
Yeah, still earlier the revaluation where earlier the value has been increased, the
Right,
same for the same line item the value has been reduced. So then
right.
why will go to PNL? I'm a bit confused here. Could you please run again?
Yeah. So earlier I told you the asset was at 1 lakh. Okay. The fair value increased to 1,10,000. So the 10,000 gain will go to OCI.
Yeah.
Okay. Now I'm saying the value has dropped from 1,10,000 to 90,000. So isn't that a 20,000 decrease?
Yes.
Okay. Do we have 20,000 of gain in the OCI to reverse, or do we have only 10,000?
20,000 we have to reverse.
We right, but do we have a gain of 20,000 in the OCI?
Yes, because we earlier that gain have moved to PNL, right? From sorry to OCI.
Yeah, so that was only 10,000 gain, right?
Yeah, yeah. Got
Okay,
it.
so that's why I'm saying 10,000 we reverse from the OCI. The other 10,000 of the value which has dropped will be directly expensed to PNL.
Yeah, yeah. Got it.
Okay, that is what your recognizing revaluation gains and losses is. Okay, now note the offset of gains and losses between different properties is not permitted. Okay, you can do it for the same line item, but when it comes to a different line item, you cannot do it. Okay, you cannot offset a reval gain for a machinery for to a reval loss for a building. Okay, it has to be the same line item. Okay, now depreciation of revalued assets. How do we charge depreciation on revalued assets? Okay, so it's very simple. There's nothing difficult in this. Whatever is the revalued amount, okay, if we have any residual value, we'll subtract that residual value from the revalued amount, okay, and divided by the remaining useful life. That is what depreciation is. That charge will go to the statement of P&L, which is your depreciation charge, and it will reduce your assets value. Okay, so anyone has any doubts in revaluation, you all can just let me know. Other than what I've taught you all also, other than that, if you all have any doubts from any part of the topic. Okay, can I move ahead? Okay, so we have a lot to cover. That's why I'm not getting into detail of each and every topic. So can we move ahead with this? Okay, let's move ahead. So disposal of revalued non-current asset. Now, when you have a profit on disposal of a revalued non-current asset, where should it go? If there is a profit on disposal for a revalued asset, where will the profit go? Can anyone type it in the chat box? PNL, okay. Pawan, it will not go to OCI, it will go to PNL. Profit on disposal of any asset will go to PNL. Okay, similarly, if there was a revaluation gain on that particular asset which you had recognized previously, that revaluation gain will, or revaluation surplus, you can say, will now move to the retained earnings, which is your equity. So if you all read the second point, any balance on the revaluation surplus relating to this asset should now be transferred to retained earnings. So retained earnings is a part of equity. Everyone agrees with that. Okay, so it will move to your retained earnings. So someone had previously mentioned that revaluation surplus goes to retained earnings, goes to equity. So this is when it is transferred to retained earnings, when you sell that asset.
The word revaluation surplus is we have to consider retained earnings.
No, so when the asset is sold, it will be added to your retained earnings. Okay, so in the statement of changes of equity, you can put down a line item as revaluation surplus and then keep it below retained earnings or in the retained earnings column.
Okay, thank you.
Okay, now let's come to the next part, which is accounting for government grants. Okay, so there are two types of grants. Can anyone tell me what are the two types of grants? The two types of grants which government provides us with? Revenue and capital, right? Okay, so revenue grants are your grants related to any expenses which you will incur. So you can see example contribution towards payroll cost. So all these grants have some terms and conditions which are attached. Okay, the government will not give you grants just like that. So probably a revenue grant you'll get, say, if you hire some people from this particular village. Okay, you give them jobs in your factory, the government will give you some grant towards paying their salaries or something. Similarly, capital grants contribution towards purchase of non-current assets. You get some grant from the government that which will help you to purchase your non-current assets. So probably that also has some terms and conditions attached that you need to distribute some of your products for free to the charity, or you will have to sell it at a subsidized cost to the government employees, etc. Okay, these are your terms and conditions which are attached. So did you understand basic meaning of revenue grants and capital grants?
Basically, grant, the word grant refers to any tangible asset or something like service. What exactly the word grant denotes?
Okay, so uh, I will answer your question as and when we move forward. Okay, both the grants have, so revenue grants are treated separately. They have a other way of treatment, whereas capital grants also have a separate way of treatment. Okay, grants as a word doesn't have a common meaning. Revenue grants have a different meaning, and capital grants have a different meaning. Okay. So there are two principles when determining the treatment of grants. So one is prudence. It should not be recognized until the conditions for receipts have been complied with and there is reasonable assurance that grant will be received. Okay, this is the conditions which I was talking about. You cannot recognize any grant until you meet all the conditions. Similarly, there is one more concept of, so everyone knows what is prudence concept. Okay, so you're all accounting students, you all should know what concept of prudence is. Okay, similarly, there is a concept of accrual. Grants should be matched with expenditure towards which they were intended to contribute. Okay, so if it is a payroll grant which you've received, we can reduce that amount from the payroll costs which the company incurs. Okay, let's see revenue grants. Okay, we'll directly see the presentation of revenue grants. Okay, so who had asked me the question, what is grants exactly? What's your name? Are you
Vishwam.
Vishwa? Okay, so we are now, I'm talking about revenue grants. Now, these grants are presented in the statement of profit or loss as a credit item. Okay, so you are receiving the money. Okay, it is an income for you, so you will present it in the credit side of the P&L. Now, similarly, if there is a specific expense for which the grant has been received, what you will do is you will deduct it from the related expense. So, okay, that is, there are two ways of presenting your revenue grant. Okay, so one is either you present it on the credit side of the P&L. Okay, if you don't know for which expense are you getting the grant, and if you know which expense like a payroll cost, you directly deduct it from the payroll cost. Okay, anyone has any doubts with revenue grants? Okay, then similarly, we have capital grants. What do? We write off the grant against the cost of the non-current asset and depreciate the reduced cost. So say the capital asset was costing $100,000. Okay, we received a grant for $20,000. We'll reduce the cost of the non-current asset to 80, which is your 100 minus 20, and then we will depreciate the reduced cost. What else do we do? Treat the grant as a deferred credit and transfer a portion to revenue each year, so offsetting the higher depreciation charge on the original cost. What does deferred credit mean? Can anyone tell me? Does anyone know what deferred credit means?
So credit will get over a period of time at different time periods.
Right. So how is a grant a deferred credit? Can you tell me?
So it based on the transaction, we have to generally I will be able to guess it.
Okay, so same example we'll take. There was a cost of 100,000, okay, and we received a grant of 20,000. How do we treat it as a deferred credit? Say the useful life of the asset is 5 years. So each of the 5 years, okay, that 20,000 amount you divide it by 5. So how much is that? 440. Okay, 40 will go each year to the revenue. Okay, and offsetting the higher depreciation charge on the original cost. So what would be your depreciation charge on the original cost? 100 divided by 5 or 1. Okay, I'll just explain it to you all very simple. So everyone understood the first method. Can everyone see my screen? Just write it in the chat box once. Okay. So first method, okay, cost of the asset. Okay, we'll take as 100. Okay, we received a grant. Okay, this is a capital grant of 20. Okay, cost becomes this minus this. Okay, this was the first method which we saw. Coming to the second method. Okay, cost of the asset is 100. Okay, useful life is your 5 years. Same useful life is 5 years out here. Okay, I'll just write it. So depreciation also I'll calculate for this. Okay, assuming no residual value. Okay, what is the depreciation out here? 20. Okay, we received a grant of 20. Now they have said we will treat this as a deferred credit. Okay, so we need to utilize this for the next 5 years. So every year from this 20, we'll put a portion of this to the revenue. Okay, we'll treat it as income in the P&L statement. So how much will go to the P&L every year? Can anyone tell me? How much will be transferred to the P&L every year from this 20? 4, right? So that is your 20 divided by 5. Sorry. Okay. Now, if you see, the actual cost related to the asset will remain as 16. Okay. You will charge depreciation of 20 and you will charge an income of 4. Okay. So in the end, your depreciation charge will remain as 16. You use any method, okay, your depreciation charge will remain the same. Has everyone understood this concept? Right. So it will be credit your deferred liability. Okay. What will be debit? Can anyone tell me? Anyone? What will be debit? Preeti?
Debit income. Debit this. The credit will be income. Grant income.
We will debit the grant income. Okay. So you are creating a liability. Whenever you want to create a liability, remember it has to be credit. Okay.
Yeah, that's fine.
Now, every year when you are reducing the liability, okay, we've created a liability, so you can say this will be debit your grant income or something. Okay, next year what you'll do is you debit your deferred liability. Okay, you are reducing it and then you will credit your P&L. Okay, so this will be 4 and 4, right?
Yeah, right.
So everyone's clear. Okay, this is very important again for MCQs. Okay, let's come to the next part, which is borrowing cost. Can anyone tell me what is borrowing cost in 1 or 2 sentences? We had read on top also that borrowing costs are allowed to be capitalized. So can anyone tell me what are borrowing costs? Okay, so basically if you want to fund your asset, so you're constructing a building, you don't have enough funds to construct that building. Okay, you take a loan to construct that building. For that loan, you need to pay interest. Okay, that interest is known as borrowing cost. Okay, when you are taking a loan, you are paying some cost for that loan. That cost is known as borrowing cost. Okay, you can capitalize those types of cost. So whenever the intended use is ready, like after that, if any cost is there, that you cannot capitalize. Okay, till the asset is created, you can capitalize the cost. Okay, anyone has any doubts in borrowing cost? Firstly, everyone understood what exactly borrowing cost meant? Just type yes, no, anything. Okay. Now let's come to IAS 40 investment property. Can anyone type out the difference between IAS 16 and IAS 40? What is the difference between investment property and property plant equipment? Held for holding. Okay, PP is for entities use, and investment property is probably to earn rentals, or you invest in property so that you might get some capital appreciation from that land. Okay, those are your investment properties. How are they? Is there any uh, way you, or is there any difference in the recognition of investment property than your PPE? Okay, there's only one major difference. So cost model, reval model, same thing will be there. Cost model again is the same as your IS 16. Only one difference in fair value model. Any change in your fair value of your investment property, okay, it will not go to statement or other comprehensive income. It will directly go to statement of P&L. Okay, and one more thing, no depreciation is charged on the asset. What are you trying to say, Vishwam? Can you just unmute and say? Vishwam, can you just unmute and say what are you are trying to ask? Okay, so uh, I can't get what he's asking as such. But did you understand the major difference between fair value model for PPE and fair value model for investment assets? Okay, so we can move forward if everyone's understood it. Okay, great. So one chapter is done. Does anyone have any doubt in this? Okay, you all can just ask me right now before we move on to the next one. If no, just type a yes so I can move on. Okay, can anyone tell me the IAS for intangible assets? Okay, you can type it out. IAS 38. Okay. Can anyone give me examples of intangible assets?
Goodwill, patents,
Okay. When is goodwill? What is goodwill? Copyrights, okay. License fees, okay. Okay, so all of these are intangible assets. Okay, now let's see how do we recognize such assets. So license and quotas, okay, intellectual property, brand names, which is your goodwill, trademarks, etc. Okay, now we see how do we recognize such type of assets. If an intangible asset is purchased separately, such as license, patent, brand name, it should be recognized initially at cost. Okay, so everything initially is measured at cost, recognized at cost. Now, after initial recognition, what do we do? Again, it has your cost model, reval model. Cost model will be the same thing as your PPE. Rather than calculating depreciation, we'll calculate amortization. Okay, so intangible assets should be carried at cost less amortization and any impairment losses. Can anyone tell me what is impairment? Does anyone know the IS for impairment? Now, when does impairment occur? What is impairment? Anything related to impairment. Okay, IS 36. Prachi, can you tell me what is impairment? Or you can tell the whole class. Okay, impairment occurs when recoverable amount is less than value in books. So that is your carrying amount, Preeti. When recoverable amount is less than your carrying amount, right? So that is when impairment occurs. So this model is more commonly used in practice. Amortization works the same way as depreciation. Okay. An intangible asset with finite useful life must be amortized over that life. An intangible asset with an indefinite useful life should not. Can anyone give me an example of an intangible asset with indefinite useful life? Okay. Is customer data, okay, you have data of customers. Is that an intangible asset? Anyone? Is customer data an intangible asset? So say Amazon has data of all the users which are using Amazon. Okay, what are the preferences, what they buy every month, and how much quantity they buy every month. Do you think this is useful to any other company who is in the same lines as Amazon? Okay, so is it an intangible asset for Amazon? That's what I'm asking. Can Amazon sell the whole customer data to another company? Okay, you can definitely sell the whole customer data to another company. Customer data is a very good example of intangible asset. Okay, my question was, is it a finite useful life or indefinite useful life? Okay, that's what I wanted to ask. Customer data. Or you can just cite it if, and whatever you all think, finite or indefinite. Okay, Prachi, why indefinite?
Because the data can change in time.
Yeah, so that should be then finite, right? Because your public or the customer, after probably, say if he's 20 years old, after estimation of a normal living being would be 85, 90 years. So after 40 years, he'll die, right? So is it finite or indefinite? Probably that whole lot of customers, you cannot use it indefinitely. Probably say after an average of 60 to 70 years, that customer data will become irrelevant for you because customer preferences will change later on, right? So it is a finite useful life of when it comes to customer data. Okay, everyone understood what finite and indefinite means? Anyone has any doubt in till here, till the cost model? Then we'll move on to the reval model. Okay, okay, so I'll move on. Now, reval model is again similar to your PPE. The intangible asset must be revalued to a carrying amount of fair value less subsequent amortization impairment losses. Fair value should be determined by reference to an active market. Can anyone tell me what an active market is? Anyone knows what an active market is?
बच्चे
Okay, so basically an active market is where maximum number of transactions of that particular asset take place. Okay, so if someone told me license fees, now uh, okay, someone told me license fees. Now you need some license fees to operate, or say fishing quotas. You need some licenses to operate in the sea to go and fish or something. Okay, so what is the active market for that? Is your purchase and selling of those license quotas, where the market, like where people go and purchase and sell that license quota. Now, similarly for a non-current asset, okay, when it comes to real estate or something, what is an active market out there? So for land and building, it is your real estate industry. Okay, for machinery, it could be any of these industries like uh, engineering industry or whatever sector is there. Okay, now internally generated intangible assets. Can we capitalize these assets? Anyone? Firstly, what are internally generated intangible assets? Can anyone tell me that? Can you just type it? What is internally generated intangible asset? No one knows what internally generated intangible assets are. It's not purchased, its value increases over time. Right. Okay. So these are brand names which we make for ourselves as a company. We don't purchase it from external sources. Okay. So it is internally generated. So if you see now, customer lists out here, they've put it as internally generated. Okay. This is something which is you cannot recognize, but if you're selling it to someone else, that guy will recognize it as an intangible asset for his company. Okay, because he has purchased it externally from somewhere. Goodwill, brands, mastheads, publishing titles, all these are internally generated and cannot be capitalized. So cost associated with these cannot be identified separately from the cost associated with running the business. Okay, so the most important part to remember is out here is that you cannot capitalize internally generated intangible assets. Okay, Everyone good to go till here? We will move on to the next topic, which is research and development. Again, a very important topic, exam point of view. Okay, not even in F7, but also in SBR. It is a very important topic, research and development. Okay, now research and development cost. Are they capitalized? Are they expensed? Can anyone tell me? Research cost expense to P&L. Okay, and development cost? Are all development costs capitalized, or are there any criteria which they have to meet? Okay, there are some criteria which have to be met. Okay, these are the criteria which are given. Okay, you all can go to the criteria, short form given for it, pirate, which you all can learn. Very important exam point of view. You all should know which cost. Research costs are always expensed out, so that is fine. But which development expenditure should be capitalized and which should be expensed? That is important. Okay. Everyone clear with research and development cost? So we can move forward to the next chapter. Great. Next chapter is impairment of assets. So someone has said impairment of assets, which is IS 36. And you all already know when an impairment occurs. So assets are carried at no more than their recoverable amount. That means carrying amount is less than their recoverable amount. Can anyone tell me how do we calculate recoverable amount? You all can type it in the chat box. What is recoverable amount? Prachi, Preeti, Vishwa, anyone? Fair value less cost to sell or value in use, whichever is higher. Okay, that's right. So that is what a recoverable amount is. Fair value less cost to sell is very easy. Fair value of the asset will be given. Okay, you can subtract cost to sell. How do we calculate value in use? Value in use is basically the cash flows which it will be getting us in the future. You uh, get that to your present value, and that is your value in use, right? So value in use is present value of future cash flow. That's right. So if these amounts are lower than the carrying amount, then impairment has occurred and you can account for impairment. Where does impairment loss get accounted for? P&L, balance sheet, OCI, can anyone tell me? So you reduce your assets value by the impairment amount, okay, and you will expense the impairment loss to P&L. Now, when does an impairment occur? Okay, there are indicators of impairment given, very important for F7 also, for SBR also. You all should know the indicators of impairment. Okay, you all can go through it later. Now, recognition and measurement of impairment. So I'll tell you all a basic way to go about a paper which is such as financial reporting or SBR also. What you can do is write down the different types of accounting standards. So I think we covered quite a few till now. You write all of this down. Okay. Next thing is, do you write how do we initially recognize the particular accounting standard? Okay. What is the subsequent measurement of that particular accounting standard? And the third part is, if disposed of, what is the adjustment or what is the uh, classification of that particular accounting standard. So you can make a table for all accounting standards like this, and you will have a proper summary of all accounting standards before your paper. Okay, that's how I had also gone about it. It's very useful. And even if you write it down, half of your study thing or your study time will get saved by writing it down only once. Okay, so what has written is impairment loss, it all will always charge to P&L. Yes. Okay, so recoverable amount should be calculated, asset should be written down to recoverable amount, impairment loss should be immediately recognized in the statement of P&L. The only exception to this is if impairment reverses the previous gain to the reval surplus. So if there was any reval gain for that asset, and if that is impaired, then we will reverse it from the reval surplus. Okay. So everyone clear till here? Okay, impairment reversal is fine. You all can read it. No, it's not very important. So we also have a time limit, okay, shortage of time. So I cannot get into all the topics as of now. So I will just do the important ones. Okay, cash generating unit. Does anyone know what a CGU is? You all can write it down, type it. Okay, so impairment calculation is always based on a CGU. CGU is any unit which is capable of generating cash. Okay, so value and use calculation may be impossible on a single asset because the individual asset does not generate distinguishable cash flows. Okay, only a machinery cannot generate cash. You need your sales team, you need people who are working on that machinery, all of that together. You need a building where the machinery will be placed. So all together is known as a CGU. So smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflow from other assets. Okay. Do you all know how to impair a CGO? Like which items are impaired first and then in the proportion you would impair the other assets? Prachi, Priti, Pavan, anyone knows how to go about this calculation? Okay, so any goodwill which is present, firstly you need to impair that whole goodwill. Okay, then if there is any remaining impairment amount which is left, you will prorata it with the other assets which are present in the CGU. I'll just show an illustration. Okay, here is a question. Goodwill is given as 20. We have other assets which are given as out here. Can anyone tell me what is the impairment amount out here first? Can you type it in the chat box? What is the impairment loss out here? Prachi, Priti, Pavan, anyone? What is the impairment loss? $70. Okay. Can you just tell me how you got that? Okay. So 20 plus 5, 25, 35, 85. Okay, 85 and 70, 155 minus 85. Okay, so that is your 70. So from 70, 20 will go off to goodwill. The rest you will do on a pro rata basis. Now, other net assets include inventory and receivables. It is considered that the carrying amount of other net assets is a reasonable representation of their NRV. So we will remove net assets. Okay, so it will be 5, 10, 50, and 30. The remaining 50 will get allocated to these for on pro rata basis. Okay, I'll just show it to you all. Third illustration. Okay, can you all see this? Goodwill 20 has gone, so impaired value becomes 0, and pro rata of the remaining one. Okay, they've got technology is considered to be completely worthless and thus for first must be written down to nil. Okay, we missed a line where it says technology was completely worthless. So again, technology 5 will remove. So the impairment balance is 65. Then they calculate your pro rata on brand, land, and building, and they get these amounts which are given out here. Are we good to go with impairment? Okay, CGU is very important again for your MCQ part. Okay, let's move forward. Okay, if you all want anything, if you all want to ask anything, just let me know. If there's any specific for me to do, I can do that also. You can just type it out. Any specific topic you all want me to do? Once impairment testing is done, so it is to be done every year. Impairment review of goodwill is to be done every year. Okay, you need to review your goodwill for impairment every year. Similarly, we read about indicators of impairment. So if there are any indicators of impairment, then an impairment review is necessary. Okay, it's not compulsory to do it every year, but if you feel there is any indicator of impairment, so as an auditor, they will figure out if there are any impairment indicators, and they will ask the company to do an impairment review if they've not done it. Okay. Now, non-current assets held for sale and discontinued operations. Which IFRS is this? IFRS 5, right? Okay. So, when do we uh, classify an asset held for sale? There are some criteria which are given where you can directly classify it as held for sale. Very important to know these criteria from FR point of view also and from SBR point of view also. Okay, all these criteria are very important. As such, this chapter doesn't have a lot of calculation, so knowing the standard is important. Okay, and what is a discontinued operation? A component of an entity that has either been disposed of or classified as held for sale. It represents a separate major line of business or geographical area, part of a single coordinated plan to dispose of a sort. Okay, all this is fine. Okay, there's nothing very difficult in this, so that's why I'm breezing through it. You all can just go through it later on also. Okay, we just this is what you need to know. How do we present it in the financial statements? We write discontinued operations and profit from the period from discontinued operations. If it is a loss, you write loss. Okay, similarly, assets held for sale will be a separate part of your balance sheet. In the asset side, you will just write assets held for sale. Let me see if it's given out here. It's not given. Okay, can we move ahead with the next one? Any doubts in IFRS 5? Y'all will learn much more about it when it comes to SBR. In this textbook, only knowing the criteria is important. Can we move ahead? Okay, I'm not going to do conceptual and regulatory framework. Okay, this is a completely theory chapter. You all can read through it. I will mostly be doing the accounting standards which are there. Okay, we don't need to go through these chapters. Okay, they're talking about what are assets, liabilities, and all of that. You all can read it by yourself. Similarly, I think the next chapter is also conceptual framework. Again, no accounting standards used here. You all can read it by yourself. Okay, let's come to IS 8 accounting policies and changes in accounting estimates and errors. Can you give me an example? Can anyone give me an example of change in accounting policy? Any example for change in accounting policy? Okay, basic example is your measurement basis for any asset. Previously you're using cost model, now you're using reval model. That is a change in accounting policy. Similarly for depreciation, previously you were using straight line method, now you're using written down value, change in accounting policy. Okay, that is your change in accounting policy. How do we account for it? It should be applied retrospectively. Do you all know what retrospectively mean?
It means from the start.
Right. Okay, so you need to apply it as such that the change is, you need to make the change from the start. Okay, so previously everything which you've done as a cost model, you need to now change it to reval model. Okay, so you adjust of the opening balance of retained earnings in the statement of changes in equity. Okay, I think there is no calculation you all require in this F7 right now, but when it comes to SBR, there are some questions for changes in accounting policy. Okay, now let's see changes in accounting estimates. So examples of changes in accounting estimates are useful life of current assets, non-current assets, residual value of non-current assets, method of depreciating non-current assets. So I think I mentioned methods previously in accounting policy. So no, it will come to accounting estimates. And warranty provision based upon more up-to-date information about claims, frequency, and value. Okay. So these are your changes in accounting estimate. Now, changes to accounting estimate, are they made retrospectively or prospectively? Does anyone know this? So accounting policy changes we make retrospectively. When it comes to changes in accounting estimates, then
Prospectively.
right. Okay, so we don't need to change the prior periods. Okay, we'll just change the current one, which is your prospective period. Okay, prior period errors is not important at the moment. But do you all know what prior period error means? Can anyone tell me what prior period error would mean?
Omissions or misstatements.
Right. So if you come to know any prior period error, how do we deal with it?
We'll restate the balances as if the error has not occurred.
Okay, that's right. So you will restate the balances, okay, and make adjustments to the balance as if the error never occurred. Okay. Now let's come to IFRS 13, fair value measurement. Very important throughout FR, throughout SBR. Very important chapter. Okay. Now we know what fair value is. Now there are three level of inputs which are available where you can find out how to measure fair value. So level 1, level 2 and level 3. Have you all heard about this before? So level 1 are the most reliable uh, prices which you can find. So they are they comprise of quoted prices in active markets for identical assets and liabilities at measurement date. Okay, so active markets is where trading of that particular asset takes place. This is regarded as the most reliable evidence of fair value. Similarly, level 2 is observable inputs other than those included within level 1. Okay, they are either observed directly or indirectly. This may include quoted prices for similar assets or liabilities. Okay, can you give me an example of level 1? Anyone? Okay, so now there is a piece of land which is available, say in Marine Drive. Okay, so if you are in Mumbai, there is an area which is Marine Drive. There's a piece of land or say a flat which is available in Marine Drive, okay, in one particular building. In the same building, one of the company owns a flat and it is put down as, and in that you do your operations of your business or something, it is used for business purposes. Okay, so it's there in your pp. Now you know that the value of flat is going to rise, so we can use that building's rate for the flat which you have owned. Okay, that is what a level 1 input is. It is a quoted price for identical assets and liabilities. So same square feet of area, same building, same side, sea view. Okay, all of that is same, so it is identical. Level 2 is, say you have a flat in the next building. Okay, probably there are some changes in, say, the amenities which are there and all of that, so that are observable inputs. And level 3 inputs are unobservable inputs for an asset or liability based upon best information available. So probably for the same flat, you don't have any information, there is no other building around you. So you go to some other area and check what is the rate. Okay, that is the best information available for you. So you can use that. So level 1 is the most reliable one. Level 2 is used when level 1 is not available. When either are not available, we use level 3. Okay, are we clear with the three types of inputs? Okay. Now, inventory. I'm sure you all know inventory IS2. Okay. Again, initial will be your cost of purchase and your subsequent measurement is lower of cost or NRV. Okay, so I'm not going to go into inventory that much. FIFO and all this is not important. Okay, you also just know what exactly it means, but calculation of all this is not required for F7. Similarly, agriculture, again, not important. Okay, leases, very important chapter. Can we start with leases? Now, who is a lessor and who is a lessee? So a lessor is a person who provides the asset, okay, the leased asset, and a lessee is the person who has leased the asset. Okay, so the lessee is liable to pay a lease liability and he gets the right to use the asset. So we recognize a right of use asset which represents the lessee's right to use an underlying asset. Okay. Similarly, we have a liability which is a lease liability which we need to pay every year. Now, how do we measure the liability? Now, this is lessee accounting. Okay, very easy. You recognize a lease liability and a right of use asset. Does anyone know how we calculate a lease liability? Okay, it is present value of all lease payments that have not yet been paid. Present value of minimum lease payments. Okay, that's right. So it should include your fixed payments, amounts expected to be payable under residual value guarantees, options to purchase the asset, and termination penalties. So usually any liability which is present, you need to discount that to present value. That will be a lease liability. Similarly, right of use asset is initially recognized at cost. Okay, so initial cost of right of use asset comprises of the amount of initial measurement of lease liability, lease payments made or before the commencement date, any direct cost, estimated cost of removing or dismantling the underlying asset as per the conditions of the lease. Okay, so is the right of use asset amount and the lease liability amount the same? Should it be the same or no? Why no? Okay, so I'll just show you all the entry. We are recognizing a right of use asset. Okay, debit right of use asset. What will we credit out here?
Credit lease liability.
Lease liability. Okay, so why, Prachi and Pawan, why do you all think it won't be the same amount?
Because it includes other things also, right?
Yeah, but that will usually be included in lease liability also. Okay, so this will always be the same amount. The differential amount, probably sometimes it might go to P&L. That's because you've paid off your lease liability at the beginning of the year. Okay, so that is why there must be a differential amount. For if there is any differential amount, it will go to P&L, but generally it is the same amount which you will recognize. Okay, you all will learn about it in more detail. Okay. So when it comes to subsequent measurement, this table is very important. Okay, it is continued in SBR also when it comes to leases. Okay, so you get the balance brought forward. Okay, this is calculation of your lease liability. Okay, so to work out the interest and year-end liabilities, a lease liability table is often used. The layout of the table will depend on whether payments are made at the end of the year or at the start of the year. So in arrears is at the end and in advance is at the start. So you get the balance brought forward. Okay, that is your beginning balance at the start of the year. interest is always given. There's a rate of interest given. Okay, we calculate interest on that. Payment is the actual payment which you will make in the particular year, and your balance carried forward. Again, this will come here and you need to calculate. Okay, if there's any illustration, I'll just show it to you all. Okay, illustration 1, lease payments which are made in arrears. So primary period is 4 years from December 1, 20x2, with a rental of 2000 payable on 31st December each year. Okay, so every year at the end we need to pay 2000. Present value of lease payments is given 5710. Interest rate is given 15%. Okay, so let's see this table. So in 20x2, liability brought forward, present value of lease payments 5710. We calculate interest on that 15%, which is 857. 2000 is the payment every year. We subtract 2000 and we get liability carried forward. Till the 4th year, your liability carried forward will become 0. Why will it become 0? Can anyone tell me? Can anyone tell me why the liability will become 0 at the 4th year, end of the 4th year? Preeti, Pawan, Prachi, anyone?
Initially, we have recognized it at present value.
Right.
So, like after making the payments and interest cost charge, then it will be 0. It will turn 0.
So after the 4th year, your lease liability will only end, right? You don't have to pay anymore because that was the lease period which you
Yeah,
took
lease
an
period is
asset
active.
for.
Right.
So that's why at the end of the 4th year, it becomes 0. Okay. So a non-current right of use asset is recorded at initial value of 5710, which is same as your lease liability. Annual depreciation charge will be charged 5710 divided by 4. This will go to the P&L. Okay, liabilities initially recorded at 5710. Total finance charge for the lease is calculated as the difference between total payments, which is 8000, and the initial value, which is 5710. So if you take 8000, which is your total payments, okay, and subtract it by the initial value, this is your present value of your lease payments. So that is the finance cost. Don't you all think that should be the finance cost? Okay, so 8000 minus 5710, you'll get 2290. This is just to verify if your answer or if your calculation you've done is right. Okay, this is how it can be shown. Your P&L statement is given depreciation, finance cost, your right of use asset. You take 5710 minus depreciation, non-current liabilities, current liabilities. Do you all know how to split this between non-current and current? What are current liabilities?
Which we have to pay within 1 year.
So don't you think the difference between these two, right? So current lease liability 4567 minus 3252, which is your 12 months after reporting day. That will be your current liability, and 3252 will be your non-current liability. Okay. So low value assets, again, not important. You also just know what are low value assets. Okay, there is no need to recognize a lease liability right of use asset for low value assets. Okay, so there is only lessee accounting for you all. There's no lesser accounting out here. So in SBR, you all will learn lesser accounting also. How
Or
does
excuse me,
yeah,
please explain mid-year acquisition of lease part.
where is it? I think I missed it.
Yeah, yes, it's in the top.
Okay, mid-year into a lease, this one.
Yes, sir.
Okay, so if a company enters into a lease partway through the year, depreciation and interest will need to be time apportioned. Liability table is likely to need extra columns to split the table between pre and post payment. Okay. I'll directly explain it with the help of this illustration. Is that fine?
Yes, sir, fine.
Okay. So Shine Limited entered into an agreement to lease an item of plant on 1st October. Lease required 4 annual payments of 200,000 each commencing on 1st October 20x8. So this is an advance or in arrears. Firstly, you need to determine that. Your lease payments are in advance or in arrears. Okay, so it's an advance because you're making the payment at the beginning of the year. So the plant has a useful life of 4 years and is to be scrapped at the end of this period. Present value lease payment is given as 700,000, rate of interest 10%. Okay. Now I'll directly come to the working. So did you understand how we got this? Okay, this is your right of use asset which is recognized. So if you see right of use asset is 700,000 minus the depreciation which we calculate 87,500. This is clear till 87,500 and the right of use asset part. Okay. Now, when has he entered into a lease agreement? 1st October 20x8. Our year end is 31st March 20x9. Okay. So October, November, December, January, February, March. 6 months mid-year. Okay. So what is the balance brought forward? Why is the balance brought forward 0 out here? Can you tell me? At beginning of 31st March X9, why is the balance brought forward 0?
Because we didn't have the lease at that
Right.
time.
Right. So first 6 months we don't have the lease. Now we have the lease which is 700,000. Okay. We paid 200,000 on 1st October itself. So that is why he's subtracting it right now. So balance at 1st October is this much. For the next 12 months, for the next 6 months, what will be your interest? So you calculate 10% into 6 by 12. So you get 25,000. That is your balance carried forward. Similarly, you take it out here. So for the next 6 months, for the next 1 year, we'll have the lease, right? So this 6 months also we'll have the lease. That is the next year, 6 months. So note there is no interest is charged in the first of the half year, and the interest charged in the first half of the second year reflects the interest balance on 1st October. Okay. This is the first half of the second year, right?
Yes, sir.
Okay. So we have the lease asset at this moment of time. So we will calculate your interest. Okay. When is the payment made? 1st October. Okay. So there is no payment made out here. Payment made at 1st October. So again, we will get the balance at 1st October, which is 3,50,000. So you add 525 plus your 25, which is 550 minus 200,000, which is 350. Okay. So we have the balance at 1st October 20x or y0, whatever it is. So we need to calculate the extract for the financial statement of 31st March 20x9 only. Okay, so till 20x9, even if you calculate till here, I think it's fine. Okay, what exactly was your doubt?
Sir,
That
how
you
did we calculate the current liability over there and
where
non-current liability in the answer?
they've taken this balance at 1st October 1st October.
In the current liability,
So 525 minus 350. Okay, so 525 minus 350. And your 350 will be your non-current.
okay, sir, got it.
Okay, finance cost 25,000 we calculated already out here. Okay, your finance cost is 25,000 and current will be this minus this and non-current will be 350. Okay, now I'm not getting into sale and lease back as of now. Okay, let me see how many topics are covered. Okay, we'll keep 10 minutes for just questions. If you all have any questions, how to write the paper, how to go about the studying part. Actually, I have another class at 6 o'clock, so I cannot extend it further. Otherwise, I would have, but unfortunately, I cannot. So I think Nidish will continue with you all tomorrow with the remaining topics. If you all have any doubts, just let me know right now. How to go about studying, how to practice, anything. Any doubts do you all have? Preeti, any doubts? Okay, so you all can attend tomorrow's class. It is with Nidesh sir. Okay, he is much more experienced than me. Probably he'll have a better class than me also. So just attend tomorrow's class also. He'll give you insights with industry experience and everything which is practically happening around the world. Okay, so consolidation with him will be very interesting for you all. So you all can attend tomorrow's class also. Okay, so we'll see you all tomorrow also. I hope you all had a good session right now. Knowledgeable.
Yes, sir. Thank you so much. And it was great. We successfully covered 9 chapters.
Right. And I covered the most important topics within the chapter, which are usually asked in the exam. Okay, so you all can focus on that when you all are studying.
Yes, sir. Thanks for this.
Thank you, sir.
Okay, so you all can join again tomorrow with Nitish sir.
So the link will be same.
Yeah, same link. Okay, if there's any change in link, I'll post it on the group.
Okay.
Okay. Yeah. See you all tomorrow then.
Thank you.